A few years ago, when Congress enacted the American Taxpayer Relief Act of 2012, your colleague Jeff Kolodny told me that the law permanently established a maximum estate tax rate of 40% for 2013 and beyond. But I know that one of last year's laws, the Surface Transportation Improvement Act, is supposed to raise revenue from estate tax compliance. How does it do that, Rachel, if it doesn't raise the tax rate?
That's a very good question, Mike. The IRS found that because of some inconsistencies in reporting, they were not collecting the kinds of tax revenues that they expected to collect on the income tax front. What does that mean? When a person dies, the income tax basis of the property in the estate is stepped up to date of death value, and that's the value that's the basis for calculating the estate tax and the value that's reported on the estate tax return. As you know, those assets are later distributed out to the beneficiaries of the estate, and they receive those assets, and maybe they hold them and maybe they sell them. When the beneficiaries sell those assets, to the extent that there's any gain of the sale price over the basis at which they inherited the property, they have to pay tax on that gain. So that's where the IRS felt that they were not receiving the maximum amount that they could in income tax revenues, because under the prior law, the estate tax reported amount was not binding on the beneficiaries who inherited the property for income tax purposes and later reported the income tax gain. So the IRS convinced Congress to include in their recent legislation basis consistency rules in order to collect that revenue.